Thank you. I'll get started here. Basically, I just want to get you thinking about this. Remember 2019? This is a picture from commencement weekend at UW on campus. This is the terrace. We used to be able to do things like get together and have fun. And then the part that was going on in ag, and I think a lot of you know this, is that it's been a bad year. 2019 and the years before that. This is from a meeting we did. Pam Yonke was moderating it, and there's Brad Pfaff there, and Travis Tranel, and some of those people you might recognize. The title was, I'm not ready to call it a crisis yet, but it's not good. It was focusing on farm management issues. And, we were leading the nation in bankruptcies. The dairy farmer attrition rate was at 10% per year. And I have this quote here at the bottom. That was me. And I saw this the other day, and I said, oh my gosh, a lot of farmers are just looking at this year to get this year over with. That's 2019. So a lot of farmers are just looking to get 2019 over with, said Paul Mitchell, director of Rank Agribusiness Institute. It's been a bad year. And then here comes 2020, which we thought, oh my gosh, it was just a whole nother level of unbelievableness. All the social distancing and flattening the curve and face masks and testing and runs on toilet paper and empty shelves for, meat and everything. And, we're in the middle of, I guess, the third wave of COVID now. It's been a rough year for ag, even this stuff. It was very concerning there at the beginning. I mean, I grew up on a hog farm right in northeastern Iowa, and so the hog ones is it really stuck with me because I just, we didn't do milk cows. There are a lot of dairy in Elm Key County right across there from Vernon County in those areas, but the euthanizing herds just because you couldn't have anywhere to take your hogs, that just flabbergasted me. And of course we dumped milk, and I felt proud to be part of an industry that was considered essential. And we've done a great job. We planted a crop in the middle of this pandemic, in the middle of harvesting it. I think ag has really stepped up, and we supplied food to the world. And we saw the prices collapsing here. This is beginning of the year 2020, and how much prices fell apart by the end of March there, early April. It was pretty rough out there. And so what I'd like to do today is kind of look at that 2020 crop production year here in Wisconsin. We're going to focusing on corn and soybeans, our top crops. And then I want to look at the federal support for farmers. There's been a lot of acronyms and a lot of programs, market facilitation, ARC PLC, CFAP2, the PPP, all this stuff. And the real outcome, I think, is that farm income is likely up in the state this year. Doesn't mean the stress is gone, that there's plenty of people who are still under intense financial stress. And it doesn't mean everyone. Not everyone's income is up. I'm just saying, in general, we can look at these aggregate numbers and get a good sense of it. So then the last part is financial stuff. What do you think about doing with this extra income if you are one of these people who has it? So that's kind of our focus here today. But 2019 had a lot of prevented plant. This is a figure. The left hand is the Midwest. You can see the areas that had bad problems with prevented plant in 2019. The pocket over there in South Dakota, Minnesota, North Dakota, along the Mississippi, lower Mississippi, and the Missouri River Valley. Then over there on Lake Erie, Michigan and Ohio, Indiana. And then we had plenty of it here too. And zooming in on the right here is our parts of the state that had the worst. But we had parts of the state with, a third of their acres weren't planted in 2019. And I thought, okay, prevented plant's over, 2020 is not so bad. This is prevented plant in 2020, this figure. I had no idea it was this bad in places. And again, there's that Red River Valley, that whole South Dakota, North Dakota, Minnesota border. Again, the lower Mississippi River Valley and along the Missouri River Valley somewhat there, and some other parts of the country. But some red areas here in Wisconsin and up in Michigan as well. So there were plenty of people who did have some prevented plant acres. And you look at this is the national data here. The bottom is 300 million acres. So the green is above 300 million acres of cropland. The blue is CRP, and then the red is prevented plant acres. And, last year, 2019 was horrendous with almost 20 million prevented plant acres. We had 9 million prevented plant acres this year. And again, Wisconsin wasn't immune to it, but we had some here in the state. But, only one other year was back here in 2011, we had a bad year with prevented plant. Otherwise, 2020 was the third most prevented plant acres in the history here of what we've been tracking. So it's been a wet year again for some parts of the country. I'll go back a slide. You can see the parts of the country that hit were pretty hard. This is prevented plant acres. again, we're high. In Wisconsin, you can see Dane is the one that pops up the most, and I think it's partly because it's big, but you can see that band from the Green Bay down towards Dane County, a pretty wide swath there. But in general, it was a easy plant year for most farmers. These are the planting progress from USDA. This is for corn and soybean on the each side there. The solid line is 2020. The dashed line is the 5-year average, and the dotted line is 2019. What you see here is, in general, we were about 1 to 1.5 weeks ahead of schedule of the 5-year average, and 3 weeks at least beyond, but faster than we did in 2019. You look at that horizontal distance here. Basically, in general, for those who didn't get prevented plant, we had a pretty good get your crop in year, well ahead of schedule, a week or more ahead of our normal 5-year average. This is though we had drought, not here in Wisconsin. This is looking at mid-June, mid-July, mid-August, mid-September. And in general, Wisconsin has the yellow means sort of like a little bit, it's kind of gotten dry. It's not a drought yet, but it's getting dry. And we had a little bit in, shows up in the state there in August and a little bit in September as well. But in general, we had good growing conditions. The point I'd like to point out, though, is that pocket in Iowa. Iowa's the large corn producing state, and it went from June into July, starts getting brown there. August, it's bright red, and then it's getting pretty extensive there in September. This is a different map, same data, but they sort of, these hashed red areas are drought areas, and the point I really want to make here is this figure they quote right here as in September 8th. Approximately 29% of corn production is within an area experiencing drought. So, but you notice we didn't have any drought here in Wisconsin of any serious sort. Of course, mid-August is when that derecho hit Iowa. It was just my wife's family retired into Cedar Rapids there, and this is unbelievable. I've talked to people who've been through this, and they said they'd never seen anything like this before. And these numbers are, the blue is 60 to 70 mile an hour winds. The light green is 70 to 80. The dark green is 80 to 100. The orange is 100 to 120. The red is 120 plus mile an hour winds. Category 2 hurricane tops out at 111. So this stuff is, some of these people were experiencing Category 3 level winds. And it kept going. It wasn't like a big gust. It continued. And this band across here, you can see there's one south of Des Moines and this big band across central Iowa that gets past Cedar Rapids and continues on. We had a little bit of it here compared to what they had there in Iowa, in southern Wisconsin. But it was huge. Here's what the clouds look like, but they're talking over 500,000 acres of corn and soybeans were just flattened. I talked to my wife's family in Cedar Rapids. The trees, the leaves are missing from them. There's just piles and piles of trees laying on the side of the roads all across the city. You can't buy a tree to plant. Here's what the grain bins look like. They're just blown into and blown off their foundations and smashed in by the wind. This isn't anything but the wind doing this to them. And this is why they know it blew really hard. This is a radio tower that went down. It was rated for 130 mile an hour winds, and it blew it over. And so I have never heard of anything like that. That's sort of like Florida things. This isn't a Midwestern event, but here it was, a derecho that just flattened a huge chunk of it, 7.5. So we'll say hit $8 billion, and that big chunk of that will be agricultural. But looking back at Wisconsin here, this is the percent of corn acres in excellent condition, starting in late May all the way through to the end of the year. The bright red line is Wisconsin, the bright blue line is Minnesota, and then the top 2 states are Iowa in black and Illinois in purple. It's hard to get all these other states. And what I want to get you to notice here is 2 things. We had the most corn acres in excellent condition in the country, and it lasted all year long. Our growing season was awesome compared to, and Minnesota had a good season as well. Iowa, you can see when they hit the derecho, their corn acres fell off really quickly down to 5% in excellent condition. Illinois, it's sort of in the middle of the pack the whole season. Soybeans, exactly the same thing. There's Wisconsin. We had the huge number of acres in excellent condition all summer long. And there was Minnesota on the upper end of the pack. And then Iowa, the flattening of the derecho, and then Illinois in the middle of the pack. You go to good and excellent, where you take the 2 and it gets us more we're more like everyone else, but we're still on the upper end of that pack the whole season long. What I'm trying to say is there's a lot of information saying we had a really good growing season here in Wisconsin. And, you can see the big collapse in Iowa due to the derecho taking out 500,000 acres. And then look at our harvest progress. These are the same like those other figures before, where the solid line is 2020, the dashed line is the 5-year average, and the dotted line is last year's numbers. And you can see corn silage, we're basically done, well ahead of schedule, over a week ahead of our 5-year average, way ahead of where we were in 2019. The same thing with our grain harvest. Right now, the last report just came out on Monday. We're up there at almost 80%. Silage is 95%, but I think the numbers were 27% on silage or a grain harvest last year at this time, and about 40% of silage was made at this time last year. And it was a horrible year, and we're well ahead of schedule. Soybeans the same way. We're a week plus, probably a week and a half ahead of where our 5-year average is, and way ahead of schedule relative to soybean. So again, more evidence of a good production year. And that shows up in our yields. These are yield trends from 2000 to 2020. The 2020 yield is the forecast that just came out on Monday for Wisconsin. Then again, I put Iowa and Illinois because of the top corn and soybean producing states, and then I put in the U.S. average in black. What you see is, we had our highest ever. If this number holds through, this November estimate from last week at 184, we'll have a record corn yield in the state on a bushels per acre basis. And soybeans at 53 would be our second highest. Back in 2016, we had 55, so we had a good year then. But you can see Iowa's yields are down, where our yield is likely to be the same as Iowa's if this holds. And we're not that far behind Illinois. So what we had is some really good production years and some really high yields. And 2020 is a good year for crop production. But remember, there was a lot going on. We just got lucky on the crop production part. Think about all the COVID stuff and the farm bankruptcies going on. These are the more recent numbers. We're way up there. Almost 70 people were filing for bankruptcy here. This is ending on June 30th. So there's still a lot of financial stress despite, this good production year. And prices now, this is going up through, the prices were low. And so in response to this, you guys remember all this stuff. It was pretty chaotic. There was a lot of federal support that came into agriculture here. The 2018 Farm Bill, there's the ARC and PLC, agricultural risk coverage, price loss coverage, dairy margin coverage. That was the replacement of MPP. We had about half the farmers signed up for that. We had market facilitation program payments coming in here in 2020. That was from the trade wars. They came bigger in 2019, but some of them are still coming for the 2019 crop in the 2020 calendar year. And then we had the Paycheck Protection Program, the Economic Injury Disaster Loan, the EIDL program, Pandemic Unemployment Insurance. These were run by different non-USDA organizations that farmers were eligible for money for some of these things. And then we had the Coronavirus Food Assistance Program, CFAP, and then CFAP 2. CFAP, the first one was more for the 2019. You had to do inventories of how much silage and grain equivalents and stuff. And then the CFAP 2 was by acres, and that's still going on. There's still sign up there. We even got Wisconsin Department of Revenue even had a farm support program. The state gave checks to farmers. And so we had a lot of federal support coming, in the midst of all this chaos of the pandemic. We had a good production year, but we had a lot of chaos in terms of sort of off of the farm. So this is trying to get a sense of how much money we're talking about. These were the ARC and PLC payments. These are estimates. This is from John Newton at the Farm Bureau. And these are estimates for the 2019 crop year. They would have been received by farmers after that crop year ended in September 1st. So this came in September and October, most likely, of 2020. So they came during the 2020 calendar year. And you can see we had a large swath of farmers getting money across that belt here from the Green Bay down to southwestern Wisconsin, and then across north central Wisconsin as well. But we didn't get as big a payment as they're getting in some of these lower Mississippi River Valley and other parts of the country. But this would have been mostly for corn and soybeans. PLC would have been for the corn. And that sign up is, that was for the 2019 payments. The 2020 payments won't come until September, October of 2021. And so we don't know what those will be yet. But you can see $6 billion is paid out nationally, is what the estimate's going to be. They're still waiting on acres and everything. But a lot of money there, $6 billion. This is the CFAP program. This is approximately $10 billion. This is as of September 13th. You know, Wisconsin got $520 million almost. It's quite high up there. You know, this is same as Minnesota almost. You can see we're right in we got more than Illinois, and that's because of the dairy. The dairy farmers received a big part of that CFAP. That would have been the early one, and that was focused on the 2019 crop and the 2019 market disruptions. And this paid big in Wisconsin for the dairy farmers because of the dumping milk and the collapse in milk prices. That's why Wisconsin received more money than Illinois. But you know, it's CFAP. You know, $10 billion, $500 million, more than $500 million here into Wisconsin. That's CFAP 1 or just CFAP. Here's an estimate of CFAP 2. This is going on now. It's still till the December. You have time to enroll. This is by acres for the 2020 crop. There's another $377 billion. So I'm going to slide back a few slides here. Here's ARC and PLC. We get a chunk of that from that for the 2019 crop and paid in 2020. We got $500 million for CFAP. We got another almost $400 million for CFAP 2. Haven't even talked about MFP. I couldn't find a cool map that had all the numbers and stuff like that. But the point I'm trying to make is federal support in agriculture was off the charts this year. What this figure here is back to 1933 is when it starts all the way to 2020. This is USDA data that came out on September 2nd. It has the billions of dollars given to farmers as support as of September 2nd. And it was 2020 was $37.2 billion. And this would have been paid during 2020 for the MFP, ARC and PLC, dairy margin coverage, CFAP. Does not include the PPP, Paycheck Protection Program, the EIDL, and the Pandemic Unemployment Insurance, and those money. Those come from a different agency. But you can see off the charts. We haven't seen anything like this. Then here comes September 18th when they announced CFAP 2. That's not in here. That's this big red dot. $51 million is the federal money going into agriculture in this calendar year. So you can see that $50 billion is just way up here. The best we'd seen before was back here in this year to like $25 billion. We're well beyond that, even before CFAP 2. So this is net cash farm income. So back to 1930, all the way up to 2020. Here's our big spike in, remember the $7 corn in 12, 13, 14, those really good years. Dairy had a great year in 2014 still. That's at years of really good commodity prices. There's net cash farm income with this bump of the $50 billion or up to $51 billion. There's where we are. We're at that level where we had in terms of farm income back in the those $7 corn days. This is the farm income instead of net cash farm income. This is just net farm income, got depreciation and some of these other inventory adjustments in there. But the same point, if this one's accurate, it's the second highest net farm income we're going to see in 2020. Ever in the history of U.S. agriculture. The last time was back there in it looks like 2013. We had a huge number there. We're almost at that level. This is now this is just from 2000 until 2020, and this is just net farm income. I'm going to go back a slide here. In essence, all I'm doing is zooming in on this section right in here and changing the scale, so that the blue line now is that net farm income number. And the scale is different. We've just made it zoomed in. And the green is if you, that's the part we haven't seen yet before. That's the net farm income without these government payments. So the difference between here, this dot on the far right and the green, all the way up to that giant red dot is the adding the $51.2 billion worth of government payments this year. You can see if without government payments, we'd be back below average, or 20-year average for the last 1, 2, 3, 4, 5, 6 years in a row, we've been below our 20-year average. But these payments have pushed us well over that to the second highest ever. So that's a big sizable chunk of income this year is going to come from these various sorts of government programs, some for the pandemic and some for the Farm Bill and some from the trade wars. So that's, we've had a lot of money come flying into ag. So first couple things I want to say, Wisconsin had a great production year. We got good yields. We got a bunch of federal money coming into agriculture because of the pandemic and just farm bills and trade wars. And now prices have recovered. This is a guesstimate of where prices are sort of around November 1st, late October. Everybody's above where they were back at the March 15th. And so you can see things have recovered. I'm not going to say much about prices. I'll let the next speaker talk about that. But you can see we've got crops and livestock prices have rebounded. Dairy's looking better. We got great production year for Wisconsin, and then we've also got these federal payments. So I actually think there's a lot of farmers are going to be looking at a high income year after several years of tight money. You go back, I'm going to slide back a few slides here. This is the national numbers. I mean, it's hard to get the Wisconsin numbers, but it's been pretty tight here. Below average income. We've got some government payments. You can see that split where the blue line is pulling away from the green line as we've had a lot of federal support, but it's still, it's not as good as it's been back here, a decade ago, or I'll say 7, 8 years ago in the early 2010s. And so this year, however, is the first year in a while we can have a good income year. Without it, we'd be in another tight year. So we've got this high income year, and then the question is, after several years of tight money, what's a farmer to do? We've got an unusual problem here for farmers. It's the pandemic, the trade wars, and everything. The 2019 was a horrible production year. Dairy markets collapsed. We got people dumping milk, and then here we are now all of a sudden with a bunch of money. What are we going to do with it this year? First thing is going to be tax management. Farmers haven't had this problem in a while, so just the tax brackets have changed. These are the tax brackets that will apply for 2020 calendar year, the tax year. Married filing joint, that's up to 80 to 171 now is the 22% bracket. Above that, it gets 24%. Self-employment taxes at 15.3 on the first 133,000 almost, and then after that, it's 2.9%. So all I'm doing, I want to make a point here, is that this is if your adjusted gross income on the horizontal axis. This vertical is going to be the ordinary income and self-employment taxes you would pay. This is after doing all your deductions and everything. I'm not going to get buried in those details. What I'm going to look at really is the rate. So if you got a number on the horizontal axis, divide by the number on the vertical axis and get at that effective tax rate. And that's what this is. So making nothing, the first dollar you make, you pay about 25% in taxes, and then it rises for a long time. And then it gets this large number when you get way up here in the 700,000s, where not most of us aren't, obviously. But you can see what I really want to make, the point I want to make is from $90,000 to almost $500,000, the effective tax rate for ordinary income and self-employment is upper 20s to lower 30s, 28 to 31%. There's it's very flat in here. You can look, this scale is only 20 to 34%. The effective tax rate is fairly flat for most people. It actually rises real quickly once you get it, at that kink right here. When you get into that next bracket, it rises fairly quickly. But once it hits that 132,900, it bends over because your self-employment rates drop off to only 2.9%. So you get this long decline in the effective tax rate when you're no longer subject to the 15.3% self-employment tax, but only the 2.9%. And then it hits when that last bracket kicks in at 3, when the tax rates all of a sudden jump up, you start to climb again. This kink right here, I'm going to slide back a few slides, is when you cross over into this 32% tax bracket, when you cross over that 326,000. So most people are back here somewhere, but the point I'm trying to make is from 90 to almost $500,000, you're not going to have a huge difference in the effective tax rate. It's all about 28 to 31% for everybody. So avoiding taxes is, yes, it's nice to avoid taxes, but your income, whatever, if you save yourself $10,000, it's not a whole lot different in terms of percent taxes than if you save yourself, $50,000, unless you can get way below those kink points. So I think a lot of farmers are going to be thinking about tax management and what to do with this extra money. And I think my understanding is that a lot of these people are on the line are ag lenders or people working with growers, ag professionals, not farmers. I think focusing only on avoiding taxes is sort of the wrong logic. There's more to it than that. This is an opportunity to increase our profits by increasing our productivity and reducing costs. Finding ways to invest in the new technology to improve your production, your yield, your milk production, or cutting your costs so you can make the same amount and cost you less, so that when the prices fall again, your profitability is still there. You've got something. So there's sort of 3 big ones you can do. Replace capital assets or invest in new assets. Increasing your working capital, which will help you manage your financial risk. And then pay off this deadweight debt. I'm going to spend some time talking about 3 of these. That's the first one everyone thinks about is, got to reduce my taxes. First, go out and buy some stuff and do Section 179 to bring down my taxable income. And yes, that's an advantage. That's smart to do. A lot of farmers have been putting off due to all that tight budget and the not having money. Their revolving lines of credit have been not getting paid back, and there's been a lot of financial tightness. So they put off a lot of investment on fixing up replacing the tractor, getting a new combine, getting a new chopper, you name it. They put off a lot of that replacement and renovation improvement of your capital assets, your working assets. Same thing, you can invest in the next phase of things instead of replacing necessary things that you need to have, like a new chopper or whatever, your new hay mower. You can also, maybe I should do a whole new parlor. Make the investment, go into robotic milking, maybe just expand, buy more cows, buy more land. I think the key to really emphasize to these people is it's not about reducing taxes. It's about improving your productivity and or reducing your cost of production with productive assets. This is an opportunity to take advantage of. If you've got this kind of capital lying around, do something productive with it, not something avoiding of taxes. So the idea is you want to generate rates of return that exceed the interest rate or your opportunity cost. You don't want to be doing some low rates of return things. So you don't want to invest in something that's not going to generate returns. Section 179 is extremely popular to take the full depreciation, buy $100,000 worth of cows and fully depreciate it and reduce your taxable income. That's great. Things like machinery and equipment, cattle, grain bins, fence, tile drainage, milking parlors, they generally qualify for that. You can't use land and use buildings or other facilities with multiple uses. Really make sure that your farmers confirm with their tax accountant if they think they're going to be able to do Section 179 on some of these things. It's not there. You got to make sure you got the right kind of asset. And obviously, it's kind of late to throw up a building or anything big like that, given that you want to get it done before the end of the year. But so just double check on some of these things to make sure they know that they really truly can deduct it as Section 179. And the rules have changed on the amounts as well. It hasn't, like I said, people haven't had a lot of this kind of income to do something with, and the tax laws changed in 2018 in some ways, generally better for farmers, but just to make sure you understand the rules this time around because they are a little different. The other thing I'd emphasize is depreciation. It's the hidden cost. You can buy assets to avoid the taxation, but people so many times forget about that depreciation. You don't write a check for it. You can see all the other checks you write, and then you can do tax depreciation. If you do Section 179, it's gone and you forget about it. But it is a real cost to owning this equipment. It does decrease in value every year. And the way I'm going to do a simple example to try to capture how much this cost of depreciation is. Capital recovery factors is what they use in sort of the ag finance side of things. There's Estimating Farm Machinery Costs. It's a publication by Iowa State University Extension. And it's the link is here. You just type in, Iowa State is probably the best in this stuff, and that's why people use it. And it's been updated as of 2017, just before William Edwards retired. So it's pretty current. And what it really is it estimates that cost of depreciation and the opportunity cost or the interest cost of the machinery. If you take $100,000 and use it for buying machinery, you've lost the opportunity to invest it elsewhere in your farm. So you got to think of that opportunity cost of that capital, which is you pick your favorite, what you think your rate of return internally is for your farm. Plus you got the annual loss in value from depreciation of that equipment. And so really what you're going to see is you got to really make sure you actually need the machinery and that it will improve your productivity and reduce your costs. So what I've done here is take three types of equipment: a tractor, a combine, and just a generic implement, some sort of tillage or sprayer or something like that, a mower, a baler. And they've got tables there. You can go get them from the link. Here's the interest rate or the opportunity cost of capital for you. So what you generate on your farm or what you're borrowing it at. Most of these people are not going to be, if you're doing this, you're not borrowing it. It's your own rate of return you're generating on your farm. And assuming $100,000 of equipment or machinery or tractor, whatever you're buying, the tractor, they're suggesting about a 15-year payment period, the usage of it with a 25% of the value left over at the end. A combine is 15 years as well with 15% salvage value. As I'll implement about only 10 years and about a 30% salvage value. He's got tables. You can go look it up and get the exact ones you want. And they have these capital recovery factors. And like I said, this is the way to calculate the annual cost per $100,000 is what I've got it normalized for, based off your rate of return over here on your internal opportunity cost of capital for you. Here's how much you're paying just in depreciation for that $100,000 and the opportunity cost of your capital, locking it up in this piece of equipment. It's not hard at all for a farm to be blowing $8,000 to $10,000 on depreciation and in opportunity costs and capital. Above and you got to add on top of this, you haven't even covered the costs of operating costs, fuel and maintenance and stuff like that, and all the other ownership costs. We're just focusing on depreciation and opportunity cost. And so when someone's buying a piece of equipment, a new tractor, new combine, they should be thinking that they're not, you don't write checks for this stuff. You don't write a check for opportunity costs. You don't write a check for depreciation, but you do pay these costs. When you cash out that machinery at the end of its life, you're only getting the salvage value, and you've locked up that capital for 10, 15 years, keeping you from doing other things with it, and that has a cost. And so the only point I'd really emphasize is it's very easy for a farmer to be dropping $8,000, $10,000, $12,000 a year to buy this equipment, plus all the operating costs of that machinery, above and beyond. Above and beyond those operating costs, there's a serious amount of depreciation. This is a hidden cost. So you got to really think carefully about buying machinery that you're not wasting a lot of money on something you don't really need. The last couple things are increasing working capital. It's just your current assets minus current liability. It's your rainy day fund. It's cash to do things with. And I like to emphasize two things. It's for unexpected costs. And yes, you want cash on hand so you don't have to rely on that revolving line of credit, and you can reduce your interest costs then. You can also spend less time managing cash flow in your finances. You can actually focus on being a farmer instead of worry about, oh my gosh, how am I going to pay this $1,000 bill that's due at the end of the month? But the other thing is it lets you take advantage of opportunities when they arise. I've talked to some farmers in better times who like that slush fund, that rainy day fund, that working capital. So when they had an opportunity, they could jump on it before other people were ready. Instead of having to go back and talk to the bank and do all these other things and think about it, they saw an opportunity for a good piece of equipment, they could grab it without having to spend several days. They had the money on hand. So increasing working capital makes some sense. It's really been depleted. This is the national numbers, but you can do it as percents, divide by gross revenue or whatever. The figure's going to look the same, just the numbers will change. But what we've seen is we've had higher levels of working capital here in the years past, and it's all disappeared. We've been scrimping and saving, and farmers have been getting by with a small amount of capital. All that's gone. It's been very tight, and you can pick your favorite measure, current ratio or whatever. It's gone. So a lot of farmers have depleted that working capital. The last thing is this deadweight debt. These are things that you bought, investments you made on the farm that aren't creating returns above the interest rate. You've got this debt. You've got operating loans that you borrowed at 6, 7, 8%, whatever you had them locked in for, and you still haven't paid them back yet. And you owe the money. Stuck paying interest on them when you can be moving forward on equity. And so it's just take this money you're getting and pay it off and move on. Forget about, cut your losses and get on. But the big thing is getting out from under that interest payment that's due all the time, let alone paying back the principal. It's basically refinancing or consolidating your operating loans or revolving lines of credit and getting them into lower long-term debt. People have been doing that for a long time. I'll show you some numbers in a second. That's what's been going on. You're replacing the deadweight debt at 5, 6% with the mortgage long-term debt of like 3, 4%, whatever you're getting on your land. Maybe this is a chance to actually just pay it off and put it into equity. Create some breathing room so you can make money when there is profitability returns, so that becomes returns on equity instead of returns on to whoever lends you the money. At the national level, this is what's been happening. This is back from 1970 to 2020. And the green is non-real estate debt, which we'll just call operating loans or machinery loans. And the red is the real estate debt. And what's really been happening here in agriculture since the Great Recession, the operating debt, non-real estate debt is flattened out. And in how we've been paying for all this stuff is rolling it into real estate debt, borrowing against the land. And so this is total debt here. And it's the same figure. We're back in terms of total debt to where we were back in the 1980s when we just had the big crisis hit. And more of that debt is concentrated land. This is back in the 80s now. See, they were about 50-50, but now it's way more of that debt is tied up in the land than it is in the short-term non-real estate debt. So I think we're more subject to land price fluctuations causing problems. And the other thing is, it's not a huge crisis yet in the sense that the debt load is about what it was in the 1980s, but our land, everything's worth more as well. We got more value out there. So in terms of percentage, it's not as bad, but it's still a lot of money borrowed. And I think this cash could be a way to kill off some of that, this debt and bring this down, remove some of this debt here, the red line, bring it down, or to get out from under some of these high interest loans in the green, whatever you got, and put more of your money into equity so you can capture some values that hopefully are coming from higher prices. So in short, I'm done. 2020 is a good year, high yields, promising price trends, lots of federal support. There are many farmers I think are going to be sitting on some capital, have to think about what to do with it. Replacing capital assets, invest in new assets. There's some opportunities there now. Think carefully about it. Don't forget about depreciation and opportunity costs. Increase your working capital so you got a little more money on hand to deal with risk, financial variations, and pay off some of that deadweight debt that's been holding back your profitability when the times, I think we're moving into some better prices. Okay, so I'll take a break. I'm done. Questions and comments, and just want to push the Ag Outlook Forum, mentioning it here. That'll be we're going to do it in January 26th, and we'll talk about the pandemic and some of these issues as well. So thank you.